Good evening, and welcome back to SleepWise. Tonight, we begin with a quiet question that follows many adults through their working lives, often without announcing itself too loudly at first. After the bills are paid, after some money is set aside, after the first layer of stability begins to form, what should the rest of our money do while we wait for the future to arrive? This is where investing begins, not with flashing screens or frantic predictions, but with the simple decision to place money somewhere beyond the present moment. To invest is to give up immediate use in exchange for the possibility of future growth, future income, or future security. It is a way of asking savings to do more than sit still. For some, that means owning a small fraction of a business through shares. For others, it means lending capital through bonds or purchasing a home, a fund, or some broader claim on the productive economy. The forms may differ, but the logic is usually the same. Capital is sent forward in time in the hope that it returns larger, steadier, or more useful than before. Beneath this quiet logic sits a deeper truth. Investing is not only about numbers, ratios, or market prices, it is also about uncertainty. No one can see the future clearly, and yet markets ask people to form judgments about it every day, about growth and inflation, about business quality and competition, about rates, cycles, technology, and the changing mood of the world. And because the future is unclear, human behavior begins to matter just as much as arithmetic. Beneath every boom, sell-off, bubble, and panic are familiar emotions: optimism, envy, fear, denial, greed, and the powerful urge to follow the crowd. People buy because others are buying. They freeze because others are afraid. They confuse rising prices with wisdom and falling prices with danger, even when the underlying reality is more complicated. Later, we will move slowly through these patterns and through the market cycles that seem to dress themselves in new language while repeating old instincts. But before we get there, we will first build the foundation: what investing is, what an asset really represents, where returns come from, why prices move, and how risk moves quietly through the system. If this kind of calm exploration helps you unwind, follow SleepWise, and share it with someone whose mind is still gently turning at night. For now, simply notice the elegance of the idea. A paycheck, a savings balance, a pension contribution, a brokerage account. Each is more than money in motion. Each is a claim on time, on effort, on enterprise, on the uncertain hope that what is planted carefully today may become something larger tomorrow. And so tonight, as the world softens and the hour grows later, we begin where all investing truly begins. Not with certainty and not with control, but with the decision to participate in the future anyway. From that opening question, a second one begins to form. If money can be sent into the future, what is the difference between simply holding it and truly investing it? Saving, in its purest form, is an act of preservation. You place money in cash, in a deposit, or in some near-cash account because you want it to remain available, stable, and close at hand. Savings are the quiet buffer between a person and surprise, the rent payment, the medical bill, the temporary loss of work, the journey home, the repair that could not be scheduled and cannot be avoided. Investing asks something different of money. It accepts that stability today may come at the cost of growth tomorrow, and so it sends capital into assets that may rise and fall in the meantime. In exchange for uncertainty, the investor hopes for a reward that exceeds what idle cash can usually provide over long stretches of time. This is where inflation enters the story. Softly at first, though its effects can be profound. Inflation is the gradual rise in the general price level of goods and services, which means that each unit of currency buys a little less than before. It does not announce itself with drama every day. More often, it works like weathering on stone, slow, persistent, easy to ignore in the moment, and obvious only when many years have passed. A salary may rise, a bank balance may look unchanged, and yet the real value beneath the numbers may be shifting. The same amount of money that once covered groceries, fuel, rent, school fees, or a family holiday may not stretch quite as far later on. This is why investors do not think only in nominal terms, meaning the number printed on the statement. They also think in real terms, what that number can actually do in the world. Cash, then, is not truly riskless across long horizons. It may be stable from day to day, but stability is not the same thing as preserved purchasing power. A person who avoids all fluctuation may still find, after enough years, that caution carried its own hidden cost. None of this means saving is a mistake. On the contrary, savings are essential. They provide liquidity, resilience, and peace. They give the investor room to think clearly and avoid being forced to sell long-term assets at the wrong moment. But beyond that protective layer, many people eventually realize that uninvested money can become too passive, too still to keep pace with the changing economy around it. So the divide is not between wisdom and recklessness, nor between prudent people and bold ones. It is between money, set aside for safety, and money assigned a longer job. Savings defend the present. Investing tries, imperfectly and patiently, to defend the future. And with that distinction in place, the landscape of investing begins to open a little wider. Once money leaves the stillness of cash, a new question begins to matter. What exactly has the investor purchased? A share of stock is not just a symbol, a chart, or a number changing. It is a fractional ownership interest in a business. However small the stake may be, the logic is real. The shareholder has a claim, indirect but meaningful, on future profits, on the residual value of the enterprise, and on whatever cash the business may eventually distribute through dividends, buybacks, or reinvested growth. A stock is, in essence, a claim on future economic output. A bond rests on a different promise. Here the investor is not an owner, but a lender. Capital is advanced to a government, corporation, or other institution in exchange for scheduled interest payments and the eventual return of principal. The upside is usually narrower than equity, but the structure is more contractual. In strong times, bonds may appear less exciting. In weaker times, their position in the capital structure begins to matter more. Real estate adds another form of investment claim. An apartment tower, warehouse, shopping center, office building, self-storage facility, hotel, or parcel of farmland may produce rents, appreciate through scarcity, or both. The value is not simply in the bricks, land, steel, or glass, but in the income those assets can generate and the demand others have for access to that location, utility, or shelter. Infrastructure deepens the picture further. A toll road, pipeline, utility grid, port, cell tower, airport, rail network, or power plant often earns its value from long life, essential use, high replacement cost, and the difficulty of being replicated. These are not always glamorous assets, but they sit quietly beneath modern life, collecting payments for movement, transmission, storage, connection, or reliability. Funds, meanwhile, are containers rather than single assets. An index fund, exchange-traded fund, mutual fund, pension pool, or private fund gathers many securities into one structure. For the investor, that can mean diversification, convenience, and exposure to broad parts of the economy through a single instrument. Instead of choosing one company, one bond, or one property, the investor buys a basket and accepts the blended result. So beneath the surface variety, most investments resolve into a few familiar categories: a claim on business profits, a contractual stream of interest and principal, rights to rent, usage or regulated payments, exposure to productive assets that create value over time. This is worth remembering when prices become noisy and headlines grow theatrical. Markets can make assets appear abstract, as though they are made only of momentum and sentiment. But underneath the movement, an investment is still some form of claim on future cash flows, future utility, or future scarcity. And the calmer an investor can be, the less hypnotic the screen becomes. If an investment is a claim on some future stream of value, then a practical question follows. How exactly does that value reach the investor? Sometimes the return arrives openly. A bond pays coupons, a property produces rent, an infrastructure asset distributes cash, and a business may send dividends, each payment reminding the holder that an asset is more than a price. At other times, the return is retained rather than paid out. A company may keep its earnings and use them to open new locations, build factories, improve software, reduce debt, acquire competitors, or repurchase shares, all in the hope that today's profits become a larger stream of profits later. This is why long-term investing requires looking beneath the surface of market quotes. The screen matters, but beneath it sits the deeper engine of return, the asset's ability to generate cash, reinvest that cash wisely, and increase the value of the claim over time. In broad terms, most returns come from only a few sources. There is current income, such as interest, rent, or dividends. There is growth in the underlying cash flow, and there is the possibility that the market may eventually value those cash flows more generously. That final piece can make markets seem mysterious, but the logic is fairly simple. If investors believe an asset's future income will be larger, safer, or more durable than once assumed, they may be willing to pay a higher price for each dollar of earnings or cash flow. Still, the quietest and most powerful force is often not a single dividend or a single rise in price. It is compounding, the process by which gains generate gains of their own. Compounding appears whenever returns are reinvested instead of removed. Interest earns interest. Dividends buy additional shares, rental income funds another asset, and retained earnings help create a business that may produce still greater earnings later. It rarely feels impressive at first. In the early years, the numbers can look modest because the base is still small, but as time passes, each layer begins resting on the ones that came before it. This is why investors speak so often about time horizon. A brilliant return earned briefly can help, but a decent return sustained patiently for many years can become far more consequential because the later years begin to do more of the work. The discipline required here is not only analytical, but behavioral. To benefit from compounding, an investor must often resist the urge to interrupt it, to trade too often, to extract gains too soon, or to abandon a sound process simply because the early progress feels slow. So, the logic of return becomes clearer. An investor is not merely hoping that a screen will flash green tomorrow, but participating in a system where assets may distribute cash, grow their earning power, and with enough patience, allow 1 year's progress to become the foundation of the next. And once returns enter the picture, risk arrives beside them. No investment offers future reward without uncertainty, and much of investing is the attempt to understand what kind of uncertainty one is being paid to bear. This is where people often make an early mistake. They treat risk as though it were the same thing as volatility, as if an asset that moves in price must be dangerous, while an asset that appears stable must be safe. But price fluctuation and true loss are not always the same. A strong business whose share price falls for a season may be less dangerous than a weak business whose price has not yet adjusted, and a short-term decline may be painful without being permanent. Permanent loss usually comes from something deeper: excess leverage, weak economics, poor management, disruption, fragile demand, or paying far too much at the start can damage an investment more seriously than market noise. So risk has several layers. There is business risk, financial risk, valuation risk, and behavioral risk, each one asking a different question about cash flows, debt, price, and the investor's own reactions under stress. Higher expected returns usually come from bearing something that other people find unpleasant or difficult to hold, such as cyclicality, illiquidity, complexity, or short-term pain. In that sense, return is often compensation for discomfort. If an asset were perfectly safe, liquid, understood, and loved, it would usually be priced so richly that little excess return remained for the next buyer. That thought leads naturally to valuation. However beautiful an asset may be, its worth depends on the cash it can generate in the future and the price paid to acquire that claim today. The formal methods can become technical, but the intuition is simple. Future cash is valuable, yet cash received many years from now is worth less than cash received soon because time, inflation, and uncertainty require a discount. So valuation is, at its core, an effort to translate future cash flows into a present value. If the future stream is likely to be large and durable, the asset may deserve a high valuation. But if that stream is fragile, cyclical, or distant, the price must usually be lower. This is why a wonderful company can become a poor investment if purchased at an extravagant price. The business may perform well, but if too much optimism was already embedded in the entry point, quality alone may not save the return. An ordinary asset, bought with discipline and a margin for error, can produce a respectable outcome because investing is never only about what you own, but also about what you paid. So, when investors speak of risk, they are rarely speaking of movement alone. They are speaking of the possibility that future cash flows disappoint, that the balance sheet breaks, that the price assumed too much, or that the owner loses patience at exactly the wrong time. By now, a subtle but essential distinction begins to emerge. Price is what an investor pays, but value is what an asset is worth, and the distance between those two things can shape much of the outcome. Markets often encourage people to treat price as though it were a verdict. If a stock rises, many assume it has become better. If it falls, many assume something must be wrong. But price is only the latest point of agreement between buyers and sellers, reached under the influence of fear, excitement, liquidity, and headlines. It is information, but it is not wisdom. Value asks a different question. What stream of cash, utility, or economic benefit is this asset likely to produce over time? And what is a sensible amount to pay for that claim today? The question is quieter than the market's daily chatter, but it is more durable. This is why investing cannot be reduced to finding good assets alone. A wonderful business, purchased at too high a price, can still deliver disappointing returns. If growth slows, margins soften, or enthusiasm fades even slightly, the investor may discover that quality was already reflected in the entry point. The reverse can also be true. An average or temporarily unpopular asset, purchased at a modest valuation, may offer a respectable outcome. This does not make poor businesses attractive by default, but it does remind us that returns are shaped not only by the future that unfolds, but by the expectations embedded in the purchase price from the beginning. In that sense, the act of buying contains a forecast. To pay a high multiple is to assume that growth will be strong, durable, or accelerating. To pay a lower one is to require less perfection. Price, then, is not simply a cost. It is a set of assumptions disguised as a number. This is why disciplined investors care deeply about the gap between value and price. The larger that gap, the more room there may be for error or disappointment. If the gap is too small, even minor setbacks can damage the return. None of this means precision is easy. Value is never known with complete certainty. It must be estimated, and estimates live beside uncertainty. Still, the practice matters because it changes the investor's mindset. Instead of asking only whether an asset is exciting or admired, one begins asking whether the future implied by the market is too rosy, too fearful, or perhaps roughly fair. Some opportunities require waiting because the asset is appealing, but the price is not. Others require courage because the price is low when sentiment is weak. And many should be declined because cheapness alone is not the same as value. So one of the quieter disciplines of investing is learning not merely what to own, but what not to overpay for. Beneath every purchase sits the same truth. The better the entry point, the less perfection the future must deliver. Once price and value are separated, another force begins to stand in the background of nearly every asset class. Interest rates. Rates may seem abstract at first, as though they belong mainly to central bankers, bond desks, or economics textbooks. Yet they shape the financial world. They influence how cheaply businesses can borrow, how consumers spend, how governments finance themselves, how attractive safe assets appear, and how richly investors are willing to value future cash flows. At the center of this sits the idea of the discount rate. A dollar that arrives 10 years from now is not worth the same as a dollar received today. Time creates a cost. Inflation creates erosion, and uncertainty creates doubt. Because of that, future cash must be discounted when translated back into present value. When interest rates are low, the discount applied to distant cash flows is smaller. This tends to make long-duration assets look more valuable, especially businesses whose profits are expected to arrive further in the future. Future-heavy investments often benefit from this environment. When rates rise, the opposite tends to occur. The discount rate increases, future cash flows become less valuable in present terms, borrowing costs move higher, and investors may become more selective. Highly leveraged businesses face more pressure. Valuations that depended on optimistic assumptions can start to compress. This is why rate changes matter, even when a company's products and customers have not changed. The business may be the same, but the financial lens through which investors view its future has shifted. Rates also influence what investors compare assets against. If government bonds yield very little, riskier assets may appear comparatively attractive. But if safer instruments suddenly offer meaningful income, investors may demand a larger premium before taking on equity risk, credit risk, or illiquidity. That premium is part of what people mean by the cost of capital. Capital is never free, even when markets behave as though it is. Each asset must offer expected returns that justify the risk taken by lenders and owners. If it cannot, financing becomes harder, expansion slows, and valuations often adjust. This is why periods of abundant liquidity can make the world seem unusually generous. Capital flows more easily, refinancing feels painless, and asset prices often rise together. Tighter periods can feel far less forgiving. Markets begin to distinguish more sharply between robust balance sheets and weak ones, between cash generation and stories that depend on easy money. So interest rates are not merely another statistic moving across a screen. They are part of the hidden gravity of markets, pulling on valuations, leverage, risk appetite, and the pace at which the financial system breathes. If interest rates are part of the market's hidden gravity, bonds are one of the clearest places to feel that force at work. A bond begins with a simple arrangement. The investor lends money to an issuer, and the issuer promises to make periodic interest payments and return the principal at a stated maturity date. The structure is more contractual than equity, and so bonds often appear calmer. Yet fixed income has its own subtleties. A bond's coupon tells us the amount of interest paid, but the bond's yield tells us more about what an investor earns at the current market price. If a bond with a modest coupon falls in price, its yield rises. If investors bid it up, its yield falls. Price and yield move in opposite directions, an inversion at the heart of bond markets. Then there is maturity, the point at which principal is due. Shorter bonds are generally less exposed to changes in interest rates because the investor receives capital back sooner. Longer bonds remain tied to the future for longer, and so their prices tend to move more when rates shift. This sensitivity is often described through duration. Duration is, in a sense, a measure of how exposed a bond is to changes in yields. The longer the duration, the more the bond's price may rise when rates fall, and the more it may decline when rates rise. Two bonds with similar coupons can behave quite differently. Credit quality introduces another layer. A bond issued by a financially strong government or company may offer a lower yield because the probability of repayment is seen as high. A weaker issuer must usually offer more compensation because the chance of distress, restructuring, or default is greater. So fixed income lives at the intersection of rate risk and credit risk. One asks, what happens if the general level of yields moves? The other asks, what happens if the borrower itself weakens? Sometimes these risks move together, and sometimes they do not. Bonds also occupy an important place in the financial system because they help set reference prices for almost everything else. Credit spreads reveal how cautious or relaxed lenders are feeling. Debt markets often notice strain before equity markets fully do, because lenders care deeply about downside and repayment. For investors, bonds can serve several roles. They may provide income, ballast, liquidity, or a more senior claim than equity, but they are not automatically safe in all conditions. A long-duration bond can fall sharply when rates rise, and a weaker bond can suffer when credit tightens. So even here, beneath the orderly schedule of coupons and maturities, investing remains a matter of judgment. One is still weighing price against yield, duration against resilience, and contractual promise against the possibility that the future may prove less stable than hoped. Once individual assets begin to make sense, the mind naturally turns to a broader question. How should they be combined? This is where portfolio construction begins and where investing becomes less about selecting a single admirable asset and more about designing a system that can endure different futures. Growth changes, inflation changes, rates change, and shocks arrive from directions that seemed unimportant a year earlier. A portfolio is an acknowledgement that uncertainty is plural. Diversification is the simplest response. Rather than rely too heavily on one company, one sector, one geography, or one economic outcome, the investor spreads exposure across assets whose drivers are not identical. The goal is not to eliminate risk. The goal is to avoid a situation in which one mistaken assumption can damage the whole structure. This is why concentration and diversification feel so different. Concentration can be thrilling. It offers the possibility of being very right. Diversification is quieter. It accepts from the beginning that being partly wrong is normal, and that resilience may be more valuable than conviction. Asset allocation deepens the idea. Instead of asking only which security to buy, the investor asks how much of the portfolio should sit in equities, fixed income, cash, real estate, infrastructure, or other categories. That decision shapes the portfolio's sensitivity to growth, inflation, rates, and market stress. In many cases, it matters more than the selection of any single holding. A younger investor with steady income and a long horizon may tolerate a greater weight in growth assets. Someone approaching retirement, tuition, or another known obligation may require more liquidity and more stability. Institutions think the same way because their portfolios must reflect liabilities and spending needs. Correlation matters too. Some assets appear diversified on paper, yet begin moving together when markets are strained. Others may look dull in ordinary periods, but become stabilizing when stress arrives. Diversification is not just a matter of owning many things. It is a matter of owning things that respond differently when the world becomes less cooperative. Then comes rebalancing. Over time, winners grow larger, laggards shrink, and the portfolio drifts away from its original design. Rebalancing is the discipline of trimming what has become too dominant and adding to what has fallen below its intended weight. It often feels emotionally wrong because it requires selling some strength and buying some weakness. A well-built portfolio can still decline, but sound construction improves the odds of staying invested, and staying invested matters because compounding requires survival. So portfolio design is not merely a technical exercise, it is a philosophy expressed in percentages, one that admits the future cannot be known with confidence, and that prudent investing often begins not with prediction, but with proportion. With the foundations in place, the story can widen. Up to now, we have spoken mostly about assets, cash flows, prices, rates, and portfolio design. But markets are more than collections of financial instruments. They are living systems of expectation. Earnings matter, rates matter, balance sheets matter, and cash flows matter. Yet all of these are filtered through confidence, fear, liquidity, incentives, memory, and the stories people tell one another about what comes next. In one season, markets appear measured. In another, they seem restless and emotional, moving faster than the underlying facts seem to justify. At any moment, countless participants are operating for different reasons. Pension funds are matching liabilities. Households are contributing to retirement plans. Corporations are issuing debt or buying back shares. Banks are managing capital ratios. Hedge funds are adjusting exposures. Traders are following momentum. Each actor may be logical according to its own constraints, yet the combined result can look unstable because markets are shaped by many overlapping motives. Liquidity adds another layer. In calm conditions, markets can absorb buying and selling with little drama. In stressed conditions, liquidity can thin quickly. Sellers become more urgent, buyers more cautious, and even modest exits can push prices sharply lower. This does not always mean value has collapsed. Sometimes it means the market's ability to carry transactions has weakened. Time horizon matters as well. A long-term investor may view a decline as temporary and even welcome. A leveraged trader or a fund judged quarterly may experience the same decline as intolerable. So price movement is not experienced equally. The same market can feel like opportunity to one participant and danger to another. Narrative matters too. Investors do not respond only to spreadsheets. They respond to stories about inflation, innovation, disruption, shortages, regulation, and national strength. A persuasive narrative can attract capital long before results fully appear, while a frightening narrative can trigger selling well before actual damage is visible. This is why markets can remain expensive longer than sober observers expect, and why they can fall further than the fundamentals alone seem to justify. Prices are not just mechanical outputs. They are social outcomes shaped by crowds, incentives, and changing emotional weather. Understanding this does not make markets easy to predict, but it does explain why markets move in recognizable patterns, swinging between confidence and caution, abundance and restraint. Once markets are understood as systems of expectation, it becomes easier to see that cycles are not accidents around the edges of finance. They are among its most recurring features, born from optimism, forgetting, leverage, fear, and the habit of believing that the present moment will last longer than it does. A rising market changes more than prices. It changes perception, so that the same business, the same economy, and even the same risks can begin to look very different once gains accumulate and confidence spreads. At first, the rise may be grounded in something real. Earnings improve, inflation eases, credit conditions loosen, or a new technology policy shift or industry change gives investors reason to expect stronger future cash flows than before. But bull markets rarely remain only about improving fundamentals. After a while, the rise itself becomes part of the argument, and higher prices begin to feel like evidence that the market's collective judgment must be increasingly correct. This is one of the mechanics of optimism. Investors do not merely update their expectations. They become more willing to pay a richer price for earnings, cash flow, or growth because the future starts to feel safer and easier to trust. Valuation expands alongside confidence. A company once priced with restraint may now be priced for excellence, and one priced for excellence may soon be priced as though disappointment has become unlikely. That shift can be subtle. People tell themselves they are not abandoning discipline, only adjusting it to better times, stronger management, wider margins, or a larger opportunity than they saw a year ago. Meanwhile, the emotional atmosphere begins to warm. Caution, which once felt prudent, starts to feel like hesitation, and hesitation begins to feel expensive as others appear to move ahead with growing ease. This is when social comparison starts doing quiet work inside the investor's mind. A person no longer measures an asset only against its value, but against the gains of others, whose confidence now seems to be rewarded by the market each day. Fear changes shape in a bull market. It is no longer mainly fear of losing money. It becomes fear of being left behind, fear of appearing too slow, too skeptical, or too anchored to old assumptions while the world seems to be speeding into a brighter era. Bull markets also change language. Risk does not disappear, but it is softened, reframed, or postponed, while the words used to describe companies and sectors become more expansive, dominant, inevitable, generational. Sometimes the optimism is justified for quite a while. Many bull markets are built on real growth, real innovation, and real improvements in profitability. But even then, the mood they create can stretch beyond sober analysis. Success flatters conviction. Easy gains make judgment feel sharper than it is, and rising prices give many investors the comforting sensation that the crowd itself has become a source of truth. So, a bull market is not merely a period of higher prices. It is a social climate, one in which confidence feels intelligent, patience feels costly, and the future, for a time, seems willing to reward belief. If a bull market flatters confidence, a falling market strips it away. The same investor who felt patient and long-term in good times may discover that those qualities feel very different once prices begin to decline for weeks, then months. At first, the drop may seem ordinary. A few weaker earnings reports, higher inflation, tighter policy, softer demand, or some external shock begins to pressure expectations, and many assume the move is temporary, healthy, or perhaps even welcome. But as losses accumulate, the emotional climate changes. Investors stop asking how much more they might gain and begin asking how much more they might lose. And that shift alone can alter behavior more powerfully than any spreadsheet. A bear market often contains both deterioration and reflex. Sometimes the underlying cash flows really are weakening. Growth slows, margins compress, defaults rise, or financing becomes harder to secure. Yet, falling prices also create secondary effects. Confidence weakens. Lenders become more cautious. Projects are delayed. Consumers retreat. And the market begins to amplify the economic stress that helped start the decline. This is why drawdowns feel so different from abstract risk. A portfolio loss may begin as a number, but it quickly becomes a psychological event, one that narrows time horizons and makes the future feel smaller and less trustworthy than it did before. A 10% decline can be discussed calmly. 20 feels heavier, and 30 begins to challenge memory and conviction, even when the long-term value of the underlying asset may not have fallen by the same degree. Bear markets compress time. The investor stops thinking in years and begins thinking in days, headlines, and tomorrow morning's open, as though the market's short-term verdict must contain some final truth about the worth of everything being owned. This is when volatility reveals what theory had hidden. Assets once described as long-term suddenly feel like positions, and investors who praise dislocation as opportunity may discover that opportunity feels less noble when it arrives through pain rather than abstraction. Falling markets also change social behavior. In rising markets, people discuss what they bought and how well it is going. In falling markets, they discuss what they should have sold. Conversation becomes quieter. Commentary grows harsher, and silence begins to spread across rooms that had recently been full of certainty. Yet declines are rarely clean enough to produce immediate clarity. Good businesses can trade like weak ones, expensive assets can become cheap, and cheap assets can become cheaper still as fear, forced selling, and shrinking liquidity push prices below calm estimates of value. That is what makes bear markets so difficult. They do not simply test analysis. They test the ability to endure ambiguity without converting it into panic. Between the optimism of rising markets and the anxiety of falling ones lies a broader rhythm. Markets move in cycles, and while no two cycles are identical, the sequence often feels familiar enough that each generation rediscovers it in slightly different language. A cycle usually begins with improvement. Growth returns, employment strengthens, credit becomes more available, and businesses regain the confidence to hire, expand, borrow, and invest after a weaker period. In the early phase, memories of the last downturn are still fresh. Valuations may remain reasonable because caution has not fully disappeared, and that lingering restraint can help support strong returns as the recovery becomes more widely believed. Then the expansion matures. Confidence spreads beyond specialists and early believers, and what began as recovery starts to feel like normality, while normality quietly starts to feel permanent. That is often when the cycle becomes vulnerable, Tight labor markets can lift wages, strong demand can keep inflation alive, and central banks may begin tightening policy through higher rates, stricter financial conditions, or clearer warnings that money will no longer be as easy. Borrowing becomes more expensive. Projects that looked attractive under low financing costs may no longer clear the hurdle rate, and weaker balance sheets begin to feel pressure first. Then comes slowdown. Not always dramatic and not always immediate, but noticeable in margins, hiring, capital spending, lending standards, and the tone of corporate guidance. Some businesses remain strong, but the edge of the economy begins to soften. Defaults or restructurings may rise at the weaker margins. Inventories build, and investors begin lowering the price they are willing to pay for future growth. In more severe cases, slowdown becomes recession. Demand contracts, layoffs rise, financing grows scarcer, and the market starts repricing the future downward before the economic pain is fully visible in official data. Yet recession also clears the ground for renewal. Excess capacity is reduced, weak lending is exposed, inventories are worked through, and policy may eventually ease again, allowing the next expansion to begin from a more sober base. Cycles operate on more than one clock. Some are short and tied to inventory rates and consumer demand, while others are longer, shaped by debt burdens, demographics, technology, regulation, and geopolitics. Markets do not wait for economists to confirm a phase. Prices often start falling before recession is declared and begin rising before the broader mood improves, because the market is always attempting to discount what lies ahead. To study cycles is not to assume one can time them precisely. It is to accept that abundance and restraint are recurring features of financial life, and that investing becomes dangerous whenever a single phase is mistaken for permanence. Among the most captivating features of financial history are bubbles. A bubble is not simply a market that has gone up a great deal, but a period in which rising prices begin to detach from sober expectations and are sustained by the belief that someone else will later pay more. There is often something real at the center. Railways were real, the internet was real, housing demand was real, and major technological shifts are often real as well. That is part of what makes bubbles persuasive. They are rarely built on pure fiction. More often, they begin with a valid insight, then gather exaggeration around it until truth and excess begin traveling together. As momentum builds, social proof becomes one of the market's strongest forces. People invest not only because they understand the asset, but because people they admire or fear being left behind by appear to understand it and appear to be prospering through that understanding. Neighbors talk about gains. Financial television grows more enthusiastic. Bankers bring more deals to market. Founders make bolder promises, and commentators begin using phrases that make restraint sound obsolete. New era, disruption, inevitability. Credit often plays a crucial role. Easy borrowing allows buyers to amplify their positions, and abundant financing reduces the friction that would normally slow speculation. As more money becomes available, prices rise further, which improves collateral values, which can support still more lending. The system starts to feel self-validating, as though rising prices are proving the wisdom of the assumptions that caused them. Bubbles also create a new emotional vocabulary. Participation begins to look like intelligence, and skepticism begins to look like blindness, timidity, or a failure to appreciate how profoundly the world has changed. This is why valuation often fades at the worst possible moment. Multiples that once seemed stretched are explained away by growth, scarcity, network effects, strategic importance, or the claim that traditional analysis cannot keep up with the future now arriving. For a while, this can appear true. Strong trends can continue longer than cautious observers expect, and fortunes can be made by people whose main skill was entering the crowd early enough. But the structure becomes increasingly dependent on continued enthusiasm. A missed target, tighter policy, weaker liquidity, or merely the exhaustion of new buyers can begin the reversal. Once confidence weakens, the same social forces that accelerated the rise can accelerate the fall. Holders who believe they owned the future may suddenly discover they owned something priced for perfection, and perfection is one of the least durable assumptions in markets. Afterward, the bubble often looks obvious. During the ascent, it rarely feels that way. It feels exciting, plausible, and socially reinforced, which is why bubbles survive across generations. If bubbles reveal the seduction of collective optimism, panics reveal the force of collective doubt. In a panic, selling is no longer guided mainly by calm reassessment, but by urgency, mechanics, and the fear that waiting may make escape impossible. Liquidity is one of those market qualities when it disappears. In tranquil conditions, investors assume they can buy or sell without too much difficulty because bids are present, spreads are manageable, and the machinery of exchange feels dependable. Under stress, that machinery can become thin and uneven. Prices gap lower, not because every holder has revised intrinsic value, but because many want out at once, and too few are willing or able to take the other side. This is where leverage becomes dangerous. An investor using borrowed money may be forced to sell not because the long-term thesis has failed, but because falling collateral values have triggered margin calls or stricter lending terms. A lower price creates pressure to sell, and the selling itself can push prices lower still. The process becomes circular, harsh, and detached from any patient assessment of value. Contagion grows out of these mechanics. Trouble in one corner of the market begins spreading into others, even those that seemed unrelated only days earlier. A credit fund meets redemptions and sells what it can. A hedge fund unwinds liquid holdings to cover losses elsewhere. Banks shorten risk, lenders retreat, and suddenly assets begin falling alongside weak ones because investors are not selling what they dislike. They are selling what they can sell. During panics, correlation rises and nuance disappears. Good businesses fall with bad ones. Long-term assets are dumped by short-term holders, and instruments designed for stability can wobble because their owners need immediate liquidity more than future income. The psychology of panic deepens the damage. Fear narrows attention, rumor becomes persuasive, and each new sale appears to validate the next one. In calmer periods, investors like to imagine they will behave rationally under stress. But a panic reveals how thin rationality can feel when balance sheets are strained, headlines are darkening, and prices keep falling faster than the mind can comfortably process. Panics also teach something important. They show that market prices are not always clean expressions of value. Sometimes they are expressions of pressure, of forced behavior, mismatched time horizons, leverage, and the collective rush toward safety. Eventually, the panic subsides. Policy may intervene, leverage is reduced, stronger hands return, and buyers with time and liquidity begin separating distress from impairment. While it is happening, the market feels less like a weighing machine and more like a stampede. It reminds the investor that finance, for all its models and equations, becomes intensely human when fear starts moving faster than thought. Markets do not move on data alone. They move on interpretation, and interpretation is shaped by narrative. A narrative is more than a headline. It is the story investors tell themselves about why the future will look a certain way, why an industry matters, why a technology changes everything, or why a risk that once seemed manageable may now be intolerable. These stories are powerful because they simplify complexity. Instead of holding countless variables in the mind at once, investors organize the world into themes: falling inflation, artificial intelligence, energy scarcity, policy reform, national renewal. A strong narrative gives price movement emotional coherence. It helps investors feel that they understand not only what is happening, but what ought to happen next. This is why narratives can move markets before the facts fully arrive. If enough people believe that a new technology will transform profits, capital may flow into that theme long before earnings confirm it. If enough people believe that inflation will remain stubborn, markets may reprice bonds, currencies, and equities before official data has fully settled the question. Expectations often act in advance of proof. Narratives also shape what investors notice and what they ignore. Evidence that supports the story feels important, while evidence that complicates it can seem temporary or not yet relevant. The story becomes a filter. In strong phases, it can make ordinary news appear profound. In weak phases, it can make even good news feel fragile. This is one reason markets can overshoot in both directions. A powerful narrative does not merely explain price action. It can attract more capital, create more media attention, influence corporate behavior, and strengthen the appearance that the story must be correct. And yet, narratives are not necessarily false. Many contain genuine insight. The danger is not that investors use stories, but that they become captive to them. A useful narrative helps organize reality. A dangerous one begins replacing reality, demanding that every new fact be bent back into the shape of the original belief. This is when markets become especially vulnerable. Once the story matters more than valuation, balance sheet strength, or the actual pace of earnings delivery, disappointment can arrive with unusual force. If the narrative weakens, the money that arrived because of the story may depart for the same reason. Themes reverse, leadership changes, and what looked inevitable begins to look contingent again. So, one of the quieter disciplines in investing is learning to respect narrative without surrendering to it. Stories are part of how markets think, but they are not the same as truth. They can illuminate, distort, accelerate, and distract. And because human beings are natural storytellers, markets will always be moved not only by what is, but by what people can be persuaded to imagine. Once narrative enters the picture, behavioral finance becomes easier to understand. Markets are not shaped by emotion only at the extremes. Emotion is present all the time, quietly influencing what people notice, what they remember, and how confidently they act. Behavioral finance studies the recurring ways human judgment departs from calm rationality. It does not begin from the assumption that investors are foolish. Rather, it observes that even intelligent people carry mental shortcuts that were useful in ordinary life but can become costly in markets. One of the most powerful is loss aversion. A loss tends to hurt more than an equivalent gain pleases. Because of that, investors may hold losing positions too long, hoping to avoid the emotional finality of admitting the loss, while selling winners too early to secure the comforting feeling of having been right. Then there is recency bias. The mind gives unusual weight to what has happened lately. If markets have risen for months, it becomes easier to believe they will continue rising. If they have fallen sharply, the future can begin to feel permanently dark. Recent experience expands until it fills the horizon. Anchoring is another common habit. Investors fixate on a past price, a target, a peak, or the level at which they bought an asset, and then treat that reference point as though it carries deep meaning. Yet the market has no memory of where one happened to enter. The future cash flows of the asset do not become more attractive simply because the price is now below the investor's cost. Overconfidence plays its role as well. A few successful decisions can persuade people that their judgment is more precise than it is, especially when gains arrive in a strong market that would have rewarded many choices. This can lead to larger positions, higher leverage, more trading, and less humility than the evidence actually warrants. Confirmation bias deepens the problem. Once investors form a view, they begin searching for information that supports it and discounting information that challenges it. A portfolio can become not just a set of holdings, but an argument about identity and intelligence. Herd behavior may be the most familiar of all. People take comfort in moving with the crowd, especially when uncertainty is high and the market seems to reward conformity. To disagree with the consensus can feel lonely. To agree with it feels safer, even when the consensus itself is stretched, euphoric, or panicked. None of these tendencies are rare exceptions. They are normal features of human judgment. That is why behavioral discipline matters so much in investing. The goal is not to become emotionless, which is impossible. It is to build habits, rules, and self-awareness strong enough that temporary feeling does not take full control of permanent capital. If behavioral finance names the biases, market stress reveals their force. Under pressure, investors do not merely think differently. They often become narrower, faster, and more reactive, as though uncertainty itself has compressed the mind. This is why behavior under stress deserves separate attention. In calm markets, many people believe they will be patient, disciplined, and valuation aware. But stress changes perception. A position that seemed manageable in theory can feel intolerable when losses are visible, headlines are dark, and everyone else appears to be reducing risk at once. One common pattern is performance chasing. In good times, investors are drawn toward what has recently worked, not because they have deeply re-underwritten the asset, but because success itself creates emotional momentum. The recent winner feels safer than it is. Then, when conditions reverse, the same investor may abandon the position after much of the decline has already occurred. Buy high, sell low is not usually a plan. It is an emotional sequence. Another pattern is action bias. When uncertainty rises, doing something can feel wiser than doing nothing, even if the action is poorly timed or not grounded in any durable improvement in information. Selling creates the sensation of control. Buying aggressively after a sharp drop can do the same, but movement is not the same as insight, and activity is not the same as judgment. Stress can also make investors confuse volatility with impairment. A falling price feels like information, and sometimes it is. But sometimes it is merely pressure, liquidity strain, or temporary fear moving through the system. The disciplined investor tries to ask a harder question. Has the long-term value truly changed? Or has the market become more emotional than analytical? Of course, that question is difficult to answer in real time. This is why process matters more than mood. An investor with position sizing, diversification, liquidity reserves, and a clear time horizon is less likely to be forced into decisions made from exhaustion or fear. Preparation is one of the quiet antidotes to panic. There is also the challenge of ego. Under stress, people do not like uncertainty being exposed inside their own thinking. They may double down to avoid appearing wrong, or they may capitulate completely because continuing to hold feels like a humiliation. Either reaction can be driven less by valuation than by self-image. This is one of the humbling truths of markets. They do not simply test intelligence, they test temperament. They reveal whether the investor can remain thoughtful when comfort disappears, when other people are emotional, and when the desire for immediate relief begins competing with the demands of long-term discipline. In that sense, stress does not interrupt investing. It exposes what kind of investing was being practiced all along. By this stage, another distinction becomes clearer. Not all participation in markets is the same, even when the instruments being bought and sold may look identical from the outside. Investing, in its deepest sense, is the purchase of a claim on future cash flows, future usefulness, or future economic value, with the intention of allowing time, discipline, and business performance to do most of the work. The investor studies what an asset is, what it may produce, what risks surround it, and what price is being paid for that claim. Patience is part of the mechanism by which the process works. Trading is different. A trader may care less about the long-term earning power of the underlying asset and more about near-term price movement, technical signals, flows, catalysts, or changes in market positioning. This is not necessarily foolish or inferior. It is simply a different activity, one with a different time horizon and skill set, and often a higher dependence on execution, speed, and risk control. Speculation sits nearby, but with still less connection to underlying value. A speculator may buy because an asset is exciting, because others are excited, or because a narrative suggests that price might rise sharply regardless of any sober estimate of intrinsic worth. Speculation can generate large gains, just as gambling can sometimes produce winnings. But its core reliance is often on sentiment, timing, and the willingness of others to pay more later. These distinctions matter because people often confuse one activity with another. They tell themselves they are investing when they are really trading, or convince themselves they are trading tactically when they are actually speculating emotionally. The language becomes flattering. A hurried bet becomes conviction. A momentum chase becomes a theme. A refusal to sell becomes long-term thinking. The confusion grows because rising markets can reward all three for a time. During euphoric phases, speculation can look like genius. Trading can feel effortless. And disciplined investing may appear slow. But different methods reveal themselves more clearly when conditions change. The investor asks whether the thesis still holds and whether the price now offers better long-term value. The trader asks whether the setup remains valid. The speculator often discovers that enthusiasm has no floor, once enthusiasm leaves the room. None of this means a person must engage in only one mode forever, but clarity matters. One should know whether the goal is to capture a short-term move, own a durable compounding asset, or participate in a burst of excitement while accepting that the outcome may depend more on crowd mood than on economic substance. Markets become less confusing when these categories are separated. Not easier, perhaps, but more honest. And honesty about what one is doing may be a valuable form of risk control available to any participant. By the end of such a journey, investing begins to look less like a puzzle to be solved and more like a discipline to be practiced. The principles themselves are not especially secret. What makes them difficult is that they must be followed in the presence of uncertainty, temptation, memory, regret, and hope. Money must first be saved before it can be invested. Cash has its place, but over long stretches it may quietly lose purchasing power. Assets differ in form, yet most are claims on future cash flows, future usefulness, or future scarcity. Price and value are related, but not identical. Return depends not only on what is owned, but on what was paid. Compounding rewards patience, but only if the investor survives long enough to experience it. Risk is not movement alone, but the possibility of permanent loss, fragile financing, weak economics, or poor decisions made at the wrong moment. Rates matter, cycles matter, liquidity matters, narrative matters. And because all of these things pass through human minds, behavior matters perhaps most of all. People chase, freeze, anchor, panic, compare, rationalize, and sometimes mistake motion for wisdom. This is why sound investing often appears less dramatic than people expect. It may involve diversification instead of bravado, rebalancing instead of prediction, patience instead of urgency, and a willingness to accept that the future cannot be known precisely. Good investors are not always the ones who forecast best. Often, they are the ones who structure themselves best, who know their horizon, who size their risks carefully, who avoid paying too much, and who do not demand that markets validate them every day. There is humility in this. One cannot control the cycle, the crowd, the policy rate, the next shock, or the next wave of enthusiasm. But one can control savings habits, leverage, valuation discipline, diversification, liquidity, and conduct under stress. Those quieter choices repeated over years often shape outcomes more powerfully than grand moments of brilliance. So investing is not merely a contest of intelligence. It is a relationship with time. It asks a person to defer, to estimate, to endure, to remain measured when the world becomes excitable, and to keep returning to first principles when prices and stories begin pulling the mind away. And perhaps that is part of why the subject endures. Beneath the formulas and screens, it is really about how human beings behave when asked to make decisions today in service of a future they cannot fully see. Tonight, we have moved through assets and valuations, cycles and bubbles, narratives and panic, psychology and discipline. And now, as the hour grows quieter, we are left with a simpler truth. To invest well is not to control the future. It is to participate in it thoughtfully, patiently, and with enough humility to know that the work is never finished, only practiced. Good night.